welcome back to episode 21 of VW Exchange. My name's Adam. I'm joined by James, and we're excited to bring back another episode for you guys today.
Happy to be back to it. Always busy here. Today we kind of wanted to start out talking about credit, and there's been a few hiccups in the private credit market, particularly First Brands and Tricolor, and Jamie Dimon's come out, express his concerns. Head of the IMF, also expressing some concerns. So that's what we're gonna dig into today.
Sounds good to me. We have this first story from BlackRock that's highlighting where credit spreads are at now. This is something that we've talked about on the pod before, but that they're at an all-time tight level. And I think the best way to see this is through where junk bonds are trading at, where lower graded debt, triple C rated debt is trading at. And it seems to be near its historic lows, which is a good thing for borrowers and firms who need access to credit, but B, could lead to more risk being out there for firms who are issuing this debt on companies that are risky and potentially not getting paid adequately for the risk that they're taking. So I'll pass it to James, though, because I know that he's got more insight here.
Sure. Yeah. I mean, I think it's kind of helpful to look at, how did we even get here in the first place? So you can look back to the 2008 financial crisis. Banks have a lot more regulations placed on them, and not as many deals are going through, not as much money out there to be lent. So private credit comes into play. Yield-seeking institutions, and there's these low rates in the economy, as well post 2008. They're looking for yields, so they're turning to private credit. Private credit, offers speed, flexibility, looser covenants, so just very flexible options. And you even see after Silicon Valley banks collapse, especially in the real estate market, a lot of these regional banks aren't lending as much. So private credit's, that's why it is where it is today. And as there's this new issuer in the space, all these banks and these firms are competing to offer better and better yields to their investors, and it kind of creates a bit of a crowding in the market. And everyone's competing, they're loosening their underwriting standards, and when things go bust, investors aren't adequately being compensated for the risk that they believe they're taking.
Yeah, I think you definitely do see this race to the bottom in terms of a lot of the good opportunities are taking up. This is a similar story to what we saw during the financial crisis, where all the good mortgages were already underwritten, so you turn to the bad mortgages and start issuing those. And I think that this is also a normal thing that you see too, and even in healthy markets where you can only get an excess return for a limited amount of time. I think that we saw some private equity for a long period of time where if you were invested in private equity, you would outperform public equity by 1,000 basis points. And then it was 500 basis points, 100 basis points, to now it's underperforming just because you have so many firms who are trying to cash in on that gold rush until, once you have so many players and so many people looking for the opportunities, they're really hard to find. And I think a similar thing's happening in private credit, where it used to have great returns relative to probably even equities, and now you're seeing them more compared to liquid credit or publicly traded credit. So you can definitely, I think, see the returns tightening, and that just to win business, that means you have to kind of keep lowering your cost of capital.
Yeah, as you said, race to the bottom, and I don't think it's ever a good sign when you're making comparisons to the 2008 financial crisis, giving out some riskier loans. But I guess the point here is just kind of that yields are so low that, there's going to be defaults, there's going to be problems. But you're not being adequately compensated for it. And that's kind of what we're seeing right now. And you do have to wonder, with a lot of the underwriting practices from these private credit firms, and a lot of them actually, which I totally didn't know this before, but actually are receiving loans, revolving credit facilities from banks. So banks are loosening their standards as well. We saw Jeffries took a giant loss, I believe, from First Brands or
I believe it was First Brands.
yeah,
Yeah.
yeah. So, the banks are also competing right now, and they're the ones offering these private credit firms these spreads, and they're loosening their standards. So you just kind of have to think about maybe the broader implications of this.
Right. And historically, too, part of the reason why I think the gap came in where private credit started to surge is that after '08, you had so many regulations come in on the banks. You made it so hard for them to issue loans to now you have a private credit sector that is wholly unregulated and really is trying to govern themselves and risk manage themselves. And we'll see through a full market cycle how well they've been doing at that and who are the people who are experienced underwriters who have been doing this for a long time and know which borrowers are creditworthy and which ones are not. And we'll find out soon which are not, because it seems like those stories are already starting to come out of who the losers in this are. But to what you said, banks are also thoroughly in the mix now on these companies. And that probably brings us to our next story, too. We've kind of mentioned it. But the collapse of First Brands and Tricolor Holdings. I can just give a brief overview on the companies. I don't know too much beyond the surface level, but we know that First Brands produces automotive aftermarket products that include windscreen, wiper blades, brake products, fuel and water pumps, so all these different auto parts that you might need. And they were a large company. They had a lot of debt at the time. They went bust. I think over $2 billion in off-balance sheet financing. I think another $4 billion left on their balance sheet at the time that they filed for bankruptcy. And then we have Tricolor Holdings too, which is, I believe, an auto lender who is making auto loans to predominantly low-income Hispanic communities in the Southwest. And they also went under, probably due to some amount of macro factors, but these have investors spooked at the moment.
Yeah, it's not a great sight, and it is very sad. It's like hearing about Tricolor, especially what they were able to do for the Hispanic community. I believe that in Texas, they only trailed like Carvana in car sales, and
Wow.
so they were a major player. And you don't think that something like this is gonna ever happen, especially when times are going well and stock market's going good, and rate cuts are coming, but not a great scene here. So I don't know where this goes from here. Do you think that this is just a couple of bad apples, or do you think this is really going to be some sort of an unwinding?
I really don't know. I think it's hard to me that something like this just slipped through the cracks with, I mean, something like off-balance sheet financing, for example, I know is somewhat common practice, but I think it's something that adds to, if it's something that's just declared okay by all these banks and private credit lenders, that there's so much financial opaqueness there and trying to really understand. Because when we look at a company, we look at their financial statements, and oh, by the way, there's $2 billion of debt that you're not seeing. That's not helpful. So when you're doing all these sophisticated financial maneuvers and borrowing against your invoice payments, so if you've sold auto parts and you have that money coming in, borrowing against that, borrowing against your equipment, and all these separate vehicles, you can see how there can just be all these pockets of risk that impact the company. Because once tariffs hit and you aren't selling as much and you aren't paying back your loans here, you could see how this trickles and starts to snowball. So I'm not sure if it's an isolated incident or not, but I think with so much macro volatility, we'll probably see, what the cracks in the system really are.
Yeah, and on to your point, forgot to mention that Tricolor was actually double pledging some of their collateral. So that means for multiple loans, they were using the same assets that they owned as collateral. So practices like that are obviously things that underwriters need to look out for and maybe need to pay more attention to moving forward. And especially kind of what we've been seeing with corporate bankruptcies at the moment. Over the past 12 months, there have been about 32 mega bankruptcies, with over $1 billion in reported assets, which is, pretty well above the 2005 to 24 average of 23 bankruptcies a year. So there's definitely some concerns there as well, and we keep coming to this corporate bankruptcy sort of topic, but that's kind of where we're at right now.
Yeah, and interestingly, I just flagged from that Cornerstone Research article that manufacturing had the highest share of those bankruptcies, which I think is probably a similar story of I don't know, of tariff stress, of competition with foreign exporters. It's unclear to me exactly where that stems from, but I think that is worth noting, and worth noting too how much of that debt, and I think that this is mostly from private credit, but probably also some from banks, of where you issue a lot of debt and it gets packaged into these CLOs and it's wrapped with all this other debt. Or same with auto loans, wrapped into an ABS securitization. So it automatically gets dumped into some ETF product that you're unknowingly buying. So as individual investors, there's really little you can do to kind of pick and choose your battles, and you're fully trusting these institutions to make the right calls. When you are a huge asset manager like BlackRock, you can like put these loans into an ETF, and if it goes down, people probably won't notice too much because of how many assets that are in there. But if you have so many of these, like ultimately, you will probably feel the pain for it at some point. But I think it is worth noting that because of these securitization practices, it's really hard to be protected. And another thing from 08 as well.
Yeah, I mean, it sounds eerily like 2008, and I think that BlackRock actually, taking out some of its investments in these corporate bonds recently, moving towards different asset classes is all you need to know as an investor, as they're the ones who are writing it. But as you mentioned before, this issue of manufacturing, and especially in the global market, of course, we know that one of Trump's big goals of his administration is to bring manufacturing back to the United States. But I think this is kind of a good time. Maybe you can bring it up, but manufacturing globally, and how trade wars might be class wars.
Right. So we're reading this book in class right now, so figured I'd bring it on the pod. But these two thinkers, Klein and Pettis, wrote a book called Trade Wars or Class Wars. And they talk about something that I think that we got to be able to discuss on the podcast a few weeks ago, which was this interaction between exchange rates and what you're able to produce domestically. So we've gotten into a situation where folks overseas in China and Indonesia and all these other countries have decided that they want to be exporters to the rest of the world and be able to stockhold wealth and invest that wealth overseas and other opportunities. So they have gone into a competition where prices have gone down. U.S. manufacturing often has not been able to compete in those realms, so prices have gone down. And as a consequence of that, their wages have gone down, their domestic consumption has gone down, and their savings have been able to go up. So that savings needs a place to go, and it's gone into the United States because they have these corporations. They also have inequality where their upper classes needs a place to put their assets into. And one of those places has been the U.S. and safe countries that have run a big deficit tab, as we have frequently discussed, and have put their money there. So the U.S. has a big deficit. They have a big surplus. And what that means for the U.S. is we are fortunate to have the benefit of this cheap debt, which is great. But also if you are living in Detroit or somewhere in the Midwest or somewhere in the Rust Belt where a lot of these jobs got stripped away, as we talked about, they've been stripped away because, one, the U.S. dollar is expensive, and it's hard to be competitive exporting overseas when your goods are that much more expensive. And, B, we know that labor costs in China, Indonesia, labor protections are much worse, so they're able to dump their goods on us. So it leads us into a situation where there are pros and cons, but we know that one of the pros is not the benefits of U.S. manufacturing, and hence the Trump administration and the guy that we read, Steve Moran, are trying to take this new angle to fix it. Whether they'll be successful is highly doubtful by me, at least, but that's their argument. They have a good systematic framework, not too different from, I think, what we saw a few weeks ago.
Yeah, that's a really good rundown. I think you hit everything that was very important, but I think that's something that a lot of people get, you hear trade deficit, that's where the U.S. is, but what you don't hear is account surplus. We are providing our safe assets, even our real estate, our treasuries are being purchased by these mass exporting countries such as China. So we are running these, we are providing these assets, and in turn, it's lowering interest rates for us to borrow as a nation. So it's a favorable deal for us, but it does come, as you said, to the expense of the manufacturing industry. And it creates a lot of disparity in those, as you said, Midwest, Detroit regions, and a lot of people are suffering. And, as you mentioned before, jobs aren't just about money. It's also sort of a morale thing.
Mm-hmm.
It's crushing when you don't have a job or you get placed out of work. And something we discussed before is in our class is how Trump really appealed to those people who were displaced out of work in these regions, and that could be attributed to why he gained so much popularity. But that's my take on all of that as well.
And no, I think that is 100% right. And I think it also raises some interesting questions going forward about how China has now, with other countries, a dominant position in lower level manufacturing or textiles and things like that. And one of the big concerns, and also something that we've talked about, is when they start to move up the value chain and they start to say, okay, we're going to be involved in semiconductors and we're going to be involved in digital infrastructure, that puts our corporations under threat. Because one of the reasons why the U.S. market's been able to do so good is because a lot of these countries produce this stuff that are inputs, and then we stick them into Apple phones and sell them for $1,100. And once that stops being the case, then our companies are going to take a big hit, and when we don't have the expertise to handle that and pivot into something else. So that would be a problem if that day were to come. But where we go from here, I'm not really sure. I'm not really sure. What are your thoughts on either the politics, economics of this? I know you kind of said that this flowed into a Trump victory, but moving forward, how do you see this dynamic playing out?
Yeah, it's a very interesting one, and you have to wonder if tariffs really are the best way to spur U.S. investment, manufacturing. You also have to wonder if government investing in particular companies, as we discussed before, not entire sectors, is the best route to go. But I do think that it is important to have local manufacturing, at least to an extent. I think COVID was a great example of this. You have a lot of, U.S. industries that shut down and are dependent on other nations for goods and for medicines and masks and all these supplies to keep us safe. So, in times of turmoil, I think it's important to have onshore manufacturing to get things out immediately.
Mm-hmm.
But I do think that there's something to be said about global trade and competitive advantage. Maybe it's not as important as we thought, and it does create some disparities between countries. So it's a very challenging topic to think about. I don't know. I don't know where we go from here.
And the one other thing that I think about too, and how we've thought about the dollar so much, is that, all of this suggests that a priori that U.S. assets, U.S. Treasuries are reserve assets no matter what. And like we can change that if we so choose. Like if we ever decide that us being the reserve asset is a problem, you can fire up the money printer to 10x speed, and none of these countries, I think, will want to hold treasuries anymore. Our class never really works from that framework and just assumes that people will hold this stuff no matter what. But if we want people to dump it and we want the exchange rate between the dollar and the yen or the dollar and the won to be lower than what it is, I think that can also be fixed. So whether it's a monetary policy approach to this is another question that I think is interesting. But that's about all I got on this.
Yeah, I mean, this is just a mouthful. This is a lot to deal with, and if it was an easy issue, I'm sure it would have been addressed harder. But I mean, as we've discussed before, maybe the U.S. dollar decline is a strategy from the Trump administration to spur more imports out of the U.S., make it more affordable for other countries. But I think that being the world's reserve asset is a pretty nice title. And if, as you said, if we do turn on the money printer, the bond vigilantes will come in and they'll sell off their bonds and yields will spike and it'll be a messy process. But I don't know.
Well, speaking of who might be hurt by such a money printing crisis, let's go back to U.S. banking. I threw on this article that discusses what some of the things that have been happening in regional banking and some of just the big trends that have been going on as a result of capitalism, for better or for worse, and a lot of reasons to think why for better and a lot of reasons why to think why for worse, but worth keeping your eye on, of a couple big mergers that have happened. Fifth Third Bank purchased Comerica Bank, PNC Bank purchased First Bank. And so these banks are really trying to gather their forces together to fight against what are becoming the really dominant players of JP Morgan Chase, Wells Fargo, Bank of America, probably some others that I'm missing. But those are the ones that come to mind. And how are you going to fight against that of really trying to strengthen your deposit base, of trying to find who's going to be the most loyal customers, whether that's individuals, whether that's businesses that'll have sticky deposits, because you want to be able to, be solvent and have people trust you. We know that that's a huge thing in the banking system, of people trust in the downturn that when they go and ask for their money that you'll have it. And also, and this is worth mentioning as well, just a side note, that the Trump administration has explored increasing deposit insurance on some of these smaller regional banks. So I think that is worth noting as well, to try and give them an edge against some of these big banks, who we know can just have more coverage because maybe they have more assets and have too big to fail status, which is a problem in and of itself. But just wanted to flip it to you of how you see this playing out long term with some of these smaller banks versus the bigger banks and them butting heads.
Yeah, good question. I mean, it does seem like the big three, like JP Morgan, Bank of America, Wells Fargo, are just completely dominant. And you could think, how could anyone even really compete with them? Especially from a banking industry, you do prioritize that trust and knowing that your money is invested in the right places and being safe. But just like anything, competition, especially in banks, I think is very important. You see banks getting started like SoFi, maybe offering high yield savings accounts versus Chase, you get 0.001% a
Right.
year. So, and you can also think about it from credit card terms. You get cash back, you get points. So competition in the banking industry is very important as well, just like companies. But moving forward, I guess it is going to have to come down to a lot of these banks merging together and trying to gain some more market share, which we're seeing right now. I think that's going to provide maybe a little bit of help here, but I don't know. I guess, as you mentioned, Trump administration increasing the insurance on deposits would be another encouraging factor.
Mm-hmm. And one thing that is just structurally concerning to me is that if we have a too big to fail system, and I think that since 2008, the biggest banks have only gotten bigger, and have had other banks folded into them. So we now have really big banks that know that no matter what risks they take, and this is where I think like some issue of moral hazard comes in, that they'll get bailed out by the government. So why not, make risky loans, high yielding loans, So that's another point of concern, that if these regional banks are willing to go bust, and we've seen that even back in 2023 when rates shot up and some of these banks like Silicon Valley Bank, First Republic, Signature Bank went under, that they didn't have the same coverage that some of these bigger banks did, and hence they got the deposit insurance, but there was no bailout waiting for them, and some of them just got folded into J.P. Morgan Chase. So I think that over time, we have rules to try and keep the big banks small, but especially when there's a crisis, it feels like the only result is government comes in, floods the system with money, big banks get bigger. I don't know how that ever stops.
Yeah, no, you bring up a very important point. I mean, if you're one of two banks and you go bust, you know that the government is gonna bail you out, or the entire economy is gonna collapse. So there's a little bit more of an incentive to make any sort of loan you want and keep trying to expand. But maybe you could think about it from another perspective as well. Maybe if you are a bigger bank, maybe you kind of step back and you don't issue as much, and maybe aren't providing the loans that need to be made. So I think that there's two sides of that. So there does need to be competition in the banking sector.
Right. And I'm glad too that we're still at a point where I think that there is sufficient competition, that all these banks are still really competing to win business. They haven't, at least to my knowledge, like really ramped up their profit margin because they know that they have some sort of monopoly, or ramped up their interest rates because they know that they have a monopoly. I think that we've still managed to see that same sort of competition. And I think to segue a little bit, a place where that competition might starting to be fading is in the airline industry. We've seen the administration come in and try to do certain things to try and protect airline competition. And one of these things was Spirit merging with, I believe it was JetBlue, and I think still might be looking to merge with someone else after filing Chapter 11 for the second time in a year. That shows that if you're one of these lower cost carriers, you're in a very difficult spot between maybe your margins are getting crushed by some of these bigger airlines and you can't compete, and there are efficiency gains to merging. But on the other side of it is that once all these mergers happen and continue to happen, we have less and less airlines. I think that something that we've seen, and this just came in the book, so I can't validate this data at all, but that profit margins are going up. We all know quality of service is terrible, continues to be terrible. That it puts competition into a tricky spot where now increasingly pricing is opaque, and I don't know that we're getting better service or more consumer welfare because of it.
Yeah, I think this is like the clear example when we look at our economy and we look at a capitalist society. This is kind of the fault, and it kind of shows, maybe there has to be at least some regulation in these industries, and it can't just run wild. I know that when Trump came into office in the first place, there kind of was expected to be this real mass deregulation, but we kind of haven't totally seen that yet. And I think that, this could be a real warning sign that maybe Trump administration is looking at, like, hey, there's a complete mess in the airline sector right now. We're going to have to maybe reel this thing in. Maybe we're not ready at the moment to go to this deregulated state. Maybe just, maybe this is just another added stressor to the economy that we can think about.
Right. And I do wonder how this ends up playing out too, just in terms of the number of airlines seems to be another thing that only seems to shrink over time, and it seems like a very hard thing for a new competitor to come in because there's such high fixed costs and there's such a value to having a network as well, that if we had only one airline and you knew that you could book the same airline for every trip and you knew that it had access to all the routes. But that's not what we have now. Is we have some that have all the routes from Denver to Los Angeles, and then you'd have to transfer to another to go from Denver to New York or whatever it might be. That is also just another barrier that it's very hard as just a local operator to be in the airline industry because people don't want to just go locally. The whole point of travel is you can go everywhere. So I think that's a problem as well. But another thing just to point out is that this isn't necessarily true across the board. An example brought up was Walmart of a company that's expanded rapidly, has been growing revenues rapidly. Their profit margin is decreasing. Prices still seem to remain low. So why the difference there between Walmart and airlines? I don't know.
I don't know. I guess we could also say similar thing to Amazon that we were talking about last
Mhm.
time. I mean, it's why does that happen? Where's that sort of convergence? I don't know. I really don't know. Is it Amazon and Walmart still trying to capture market share and then do it? Maybe the airlines already feel like they have this massive position. It's basically an oligopoly of the market, truly at this point. So I don't know. Maybe that's a lever that's to be considered. What do you think?
I think in Walmart's case that there's still like I can still name a ton of different grocery stores that I could go to if I just wanted food, or a ton of different clothing stores if I just wanted clothing. But they just run a really efficient operation. They're an everything store. So I think that all of those are tailwinds behind it. And I think in Amazon's case, I do think that they are still trying to capture market share. And I think Walmart is still trying to do the same thing too. Like I don't necessarily see that they would never come into a position where, all right, the last grocery stores are finished. Now it's time for the profit boost. I don't think that's too far fetched, but I think that grocery and clothing, I mean, that's a whole different beast to try and capture that whole market.
Yeah, you're right. I mean, airlines, it must just be the barrier to entry is just so massive that they're just very confident in the position that they have. And I guess maybe last thing I'll ask you is how do you increase competition in the airline industry today?
That's another brutally tricky question because say you break it all up, and then all of a sudden you have less efficient airlines which don't have the same network. But even so, you break them all up, and then you wait a few years, and some start to collapse and merge into each other. You just do the same thing every 10 years. It just feels like a bizarre mechanism, and I guess that's not always true, because I know that we broke up the big oil companies, and I'm not sure that we've had to do that since. But there are some businesses that seem to run better if you have complete and utter scale. Like think of a thing like Verizon and AT&T that have to have these fiber networks across the U.S. That seems like something that potentially is just better run. It would in a perfect world just be run best by one who takes no profit like the government. But if you said the government would run it, I mean, we have absolutely zero faith that they would do it well. So I have no good answers.
I hate to say that I cannot fathom a government-run single airline across the country. I think that would be a disaster, but a very Trump-like policy might be to back some of these smaller airlines and, government backing, try to increase competition. That's just a prediction. Maybe we'll see what happens, but it's a good time to call it. I think we covered a lot. I think this is a fun episode, and, we'll keep building off it.
Yes. Thank you all for tuning in. This was 21. We'll be back with episode 22 in a few weeks, but thank you again for sticking with us.
Thanks, guys. Take care.